A 7500079000 TI 95 45% 40% 15% /CH N. Good morning, investors. Let's dive straight into today's market overview. Overnight, U.S. markets were closed for Memorial Day, so we don't have fresh closing data for the Dow Jones Industrial Average. However, looking back at Friday's close, the Nasdaq 100 tracking QQQ saw a modest gain of 0.08%, closing at $717.54, while the S&P 500 tracking SPY rose 0.2% to $745.64. Market anxieties showed some easing, with the VIX Volatility Index falling 0.66% to 16.59. The 10-year U.S. Treasury yield pulled back to 4.56%, down 0.61%, offering some relief to risk assets. The U.S. dollar index DXY traded narrowly around 99.24, declining 0.08%. In commodities, WTI crude oil settled at $96.60, down 0.88%, and COMEX gold remained stable at $4,523.20, with a slight dip of 0.15%. Bitcoin, however, showed strong momentum, rising 1.45% to $77,277.46. Overall, the market is exhibiting a clear divergence. A-shares are showing significant strength, supported by robust internal liquidity, with the ChiNext index surging 2.1%. In contrast, commodities are under pressure due to shifts in geopolitical expectations, as evidenced by Brent crude's 3.93% drop, signaling a potential short-term top. Our primary market direction for today is a structural long position, with a strong emphasis on A-share technology and growth sectors, a thesis we assign a 75% probability. From a global capital flow perspective, Asian markets have set a risk-on tone, with the robust performance of A-shares injecting positive sentiment into global markets. With U.S. markets closed, global capital is primarily circulating within Asia for now. We anticipate this capital flow pattern to continue, with a 70% probability. Breaking down the macro drivers, the interest rate environment is neutral to slightly positive. The retreat in the 10-year U.S. Treasury yield reduces the discount pressure on risk assets, though long-term inflation expectations remain a potential constraint. The U.S. dollar index's narrow fluctuation provides no clear directional guidance. Inflation news is positive, as Brent crude prices have significantly pulled back to around $100.21, substantially alleviating short-term inflation concerns and providing breathing room for risk assets. Geopolitical risks also lean positive, with market expectations of de-escalation in Middle East tensions rising, which has led to a contraction in the oil risk premium and boosted overall market sentiment. Regarding core asset performance, U.S. stocks were closed today, but Friday's close indicated market resilience at elevated levels. However, some tech giants, like Nvidia, which was down 2.18%, have shown signs of pullback pressure, and the market awaits new catalysts. A-shares, on the other hand, are optimistic and clearly domestic investor-led. The CSI 300 index rose 1.58%, and the ChiNext index surged an impressive 2.1%. Driven by the central bank's higher-than-expected liquidity injection, domestic investor sentiment is buoyant, leading to a broad-based rally. Bitcoin's 1.45% rise aligns with the resurgence in A-share risk appetite, suggesting increased speculative activity. Commodities face downside risk, with significant drops in both Brent and WTI crude confirming a short-term top as geopolitical premiums are squeezed out. Gold prices remain stable at $4,523.20, indicating no heightened safe haven demand. The main funding theme is clearly A-share technology and growth, which we rate as a strong long direction with an 80% probability and high continuity. Supported by loose liquidity and industrial policies, capital is actively flowing into hard tech sectors like semiconductors and artificial intelligence. The significant outperformance of the Chi-Next and Shenzhen component indices over the main board clearly shows that growth stocks are the absolute market leaders. Conversely, the global energy sector faces a bearish outlook, as the sharp drop in oil prices will directly impact energy company earnings expectations, leading to sustained capital outflows. Looking ahead, several high-frequency catalysts warrant close attention. First, any official statements regarding the Middle East geopolitical situation, whether an agreement is reached or broken, will cause significant volatility in oil prices and risk assets. Second, the U.S. PCE inflation data, due later this week, will directly influence market expectations for the Federal Reserve's future policy actions. Of course, we must also be mindful of potential risks. A reversal in geopolitical expectations, with Middle East tensions escalating again and oil prices quickly rebounding above $105, would reignite inflation concerns. The VIX could rapidly climb above 18, dampening market risk appetite. Additionally, if A-share trading volume fails to sustain its momentum, a shrinking volume during a rally could indicate insufficient incremental capital inflow, casting